NVIDIA shareholders have had plenty to smile about lately. From just $111 in early May, the stock rocketed to $182 by early August, an eye-popping 64% surge in only 3 months. That kind of rally is enough to make even the calmest investors start fidgeting, rushing online to ask, is it still time to get in? Or even, should I go all in? And it's not just NVIDIA that's been climbing. Since hitting its low in April, the Nasdaq 100 has rebounded more than 30%, while the Magnificent 7 index has soared nearly 40%. Around the world, capital is moving with the same restless energy you feel right before a big market shift, like it's catching the scent of a new tech supercycle. From AI chips and cloud computing to ad tech and end-user devices, 4 powerhouse sectors are all in bloom. Microsoft, Amazon, Google, Meta, each one in full attack mode. A new AI race has officially begun, and the atmosphere feels uncannily like the months leading up to the tech stock liftoff of 2020. But there's a nagging question. Is this truly the dawn of another growth era, or simply the first act of a bubble? That's exactly what we're here to explore. In a market flooded with AI capital, which opportunities are worth holding for the long term, and which are just hype destined to fade. Today, we'll break down the investment logic for tech stocks in the back half of 2025, starting with the battle for chip dominance, moving into the wars for cloud supremacy, and ending with the under-the-radar application layer dark horses that could deliver explosive returns. The chip battlefield right now is dominated by 3 names: NVIDIA, Marvell, and TSMC. NVIDIA is still the undisputed leader, and its meteoric stock rise is the market's standing ovation. In May, Saudi Arabia announced a massive 500-megawatt AI data center, an order that flowed straight into NVIDIA's revenue stream. Combine that with the loosening of U.S. export restrictions, and on May 14th alone, the stock leapt more than 5.5%. But even leaders have vulnerabilities, and for NVIDIA, the biggest is concentration risk. Over 40% of its revenue comes from just 4 customers: Microsoft Azure, AWS, Google Cloud, and Meta. These aren't just the largest cloud providers in the world. They're also NVIDIA's biggest buyers of Blackwell architecture AI GPUs, ordering over 3 million units from this generation alone. Which means that if even one of them slows down purchases, NVIDIA's valuation could take a direct hit. That's why its August 27th earnings report has become such a closely watched event. Marvell, in contrast, flies under the radar. It doesn't dominate headlines, but behind the scenes, it has been quietly building an edge that could turn heads. While NVIDIA's price-to-earnings ratio hovers around 56, Marvell sits at just 25, suggesting potential undervaluation. The company has already secured exclusive rights for Microsoft's Windows management infrastructure and successfully integrated NVIDIA's NVLink interconnect architecture, moves with significant strategic weight. Those wins have fueled a 76% surge in data center revenue. The gap between Marvell's market value and its technical firepower is hard to ignore, and once the market catches on, a re-rating could happen fast. And then there's TSMC, the quiet backbone of the entire chip world. It may lack NVIDIA's brand flash or Marvell's partnership stories, but it's the keystone of this high-stakes industry. TSMC is putting $16.5 billion into a new U.S. plant and projects AI-related revenue to grow at a 40% compound annual rate. It doesn't rely on grand visions or flashy PR. It simply executes with unmatched supply chain control and world-leading manufacturing capabilities. Over 90% of the world's AI chips are born in its fabs. Whoever claims victory in the AI application space will still need to pass through TSMC's production lines. With the hardware foundation set, the fight shifts to the cloud, where Microsoft, Amazon, and Meta are all in sprint. In July, Azure's AI-driven momentum pushed Microsoft's market cap past $4 trillion. On the very day the markets opened, its stock jumped 8%. Riding on standout performance in cloud and AI. For the first time ever, Azure revealed its annual revenue, $75 billion, up 34% year over year, instantly boosting investor confidence. Yet beneath the celebration, there are signs of caution. Capital expenditure growth has slowed, sparking fears Microsoft may be approaching a plateau. The company's answer? tighten costs, improve efficiency, and refocus on profitability. AWS has even more pressure to contend with. Cloud growth is slowing, AI investment is surging, and margins are getting squeezed. Amazon's strategy is to take control of its destiny by developing its own chips, reshaping the balance between cost and performance. If it works, AWS could stage a turnaround and even redefine the rules of the cloud AI market. Meta, meanwhile, has gone all in with a spending spree on an unprecedented scale. Its 2025 CapEx ceiling is now $75 billion, with 2026 likely to top $100 billion. The goal? To build the most complete, deeply integrated AI infrastructure and model capabilities in the world. But the stakes are enormous. If revenue can't keep pace, this could turn from an asset into a burden. Analysts are already pointing to a forward PE ratio nearing 29 and a PEG ratio of 1.7, both well above comfort levels. The heavyweights get all the spotlight, but sometimes the most exciting opportunities are elsewhere. The next big winners might be companies you've barely heard of, application layer dark horses quietly positioning themselves for breakout growth. These are the firms embedding AI into the daily operations of businesses, solving tangible problems, and quietly reshaping industries. They may not dominate headlines, but they could be the Apple of a decade ago or the NVIDIA of 5 years back. The AI spotlight is shifting from those who build the raw power of chips and models to those who make AI truly usable and indispensable. UiPath, for instance, leads the world in robotic process automation, helping companies streamline repetitive, time-consuming tasks so human talent can focus on higher-value work. C3.ai serves sectors from energy to government with tailored AI platforms that foster loyalty, ensure high retention, and deliver stable revenue. These players make AI not just a showcase for the tech crowd, but a business asset investors can value and customers can rely on. If you want to identify potential application layer dark horses, there are 3 factors to consider. These players often start small, tackling a single, highly specific problem, but behind that small entry point is often a market with massive potential. LivePerson has made AI-powered customer service smoother and more human. Ironclad has revolutionized contract review by marrying machine learning with legal expertise, cutting turnaround times dramatically. Others shine by placing technology exactly where it counts. Gong.io analyzes sales conversations for emotional cues, negotiation strategies, and script optimization. Jasper.ai empowers marketing teams to generate copy and SEO content at speed, transforming output overnight. What these companies share is a crystal-clear business model that supports stable cash flow and scalable growth. They're the Microsoft Office of the B2B world. Once they're in, clients rarely let them go. Most operate on subscription-based SaaS models, which means high margins, predictable revenue, and exceptional customer stickiness. Implementation is fast and inexpensive, no hardware overhauls required, making them hard to dislodge once they're in place. So how do you spot these hidden gems and improve your investment odds? Globally, AI PitchBook tracks roughly 400 AI unicorns, with 60 to 70% operating in the application layer. Fields like healthcare, finance, education, and design. Founders Forum Group projects the AI market will reach $1.8 trillion by 2030, with application AI share rising year after year. The message is clear. Companies that can deploy AI effectively to solve real problems will be the ones investors chase hardest. When investing in such companies, consider 3 strategies. Follow early-stage VC moves. Top firms like A16Z, Sequoia, and Benchmark are like super radar stations. Many dark horses got their first funding from them. Study the business model and target problem. You don't need to understand every technical detail, but you must know what problem they solve and for whom. This lets you estimate the potential market size. Track revenue models and user growth curves. Application AI adoption is often gradual, trial, habit, dependency. The key is whether the product retains users, earns referrals, and drives renewals. These matter more than download counts or press coverage. In short, these application layer unicorns reveal a key truth. Tech innovation is just the starting line. Commercial adoption is the finish line. Breaking out of the tech bubble and into mainstream business hinges on serving a real, existing need. These dark horses don't rely on viral hype, marketing tricks, or explosive buzz. They have resilience and real capabilities, steadily embedding themselves where they're needed most, becoming indispensable business tools. The next Apple or NVIDIA may not be today's hottest stock, but one of these quiet application layer value creators. For investors, this is more than a stock pick. It's a mindset shift. In the next AI wave, the focus won't be on who upgrades tech the fastest, but on who deploys it the deepest and applies it the widest. In this transformation, we're no longer mere spectators. We are participants. When you understand where an AI company lands, you're also deciding where your capital will grow. For long-term investors especially, these seemingly unremarkable hidden gems may be the most worthy of study, patient positioning, and sustained betting in this AI race. They may not deliver quick thrills, but they could unlock the next 10 to 20 years of compounding magic. From the capital wars of AI infrastructure to the ranking battles of chip leaders and cloud platforms, we've broken down the investment logic for the second half of 2025, and for those not yet fully recognized by capital markets, we've mapped a path worth positioning for ahead of time. This is Smart Money Basics, helping you make smarter moves and build lasting wealth. If you found this breakdown useful, hit like, subscribe, and share it with someone who could use this insight. And don't forget to turn on notifications so you never miss an episode. Thanks for watching. Stay focused, and I'll see you next time.